Good morning. Welcome to the Financial Pillars All About the Money podcast presented by Our Neutral Voices Media. Our show is all about helping our audience understand money, mindsets, and tap into the economic knowledge that builds financially secure individuals, families, and communities. So whether you're tuning into our show to learn about budgeting, building credit, investing, or starting your own business, we're here to break down the knowledge in a real and relatable way. So before we get started today, Terrence, you want to take us in with a prayer?
Absolutely. All right, let's bow our heads and close our eyes. Dear Father, I thank you so much for bringing us back together again after being away for so long. I'm glad to see everybody here has made it here safely and that they've been taking great care of themselves. I'm glad to come together again, that we are able to pull our minds and pull our words and our knowledge and pretty much be able to benefit anybody that is watching today and pretty much help them understand how the financial world works around them so that they can feel confident with the knowledge that they have gained from us today moving forward to make the best financial decisions for them. I pray that you protect and keep us on our ways and as we live our lives. In your name, I pray. In Jesus' name, amen.
Amen.
Amen. Thank you. Start the show. I'm Ryan Leopard, private banker with Star Financial Bank.
JJ Foster, loan mortgage originator with Lake City Bank.
And Terrence Bush, a business universal banker at Greenway Bank.
I always love that title, Universal Banker.
That's a nice title, isn't it?
Yeah. Something you said in your prayer is, we've been gone from the set for a couple of weeks and really missed you guys. I'm glad to be on set. Get used to the routine and getting into that. When you don't see you guys for a couple of weeks, it's like I'm missing my schedule.
That's exactly right. October, long month, huh?
Absolutely. So going back a couple weeks ago to our last show, we talked about mortgages and HELOCs, home equity line of credit. So good place to kick off from there is kind of talk about rates, right? Because that's what kind of affects those things. And let's kind of start off with understanding the different type of rates. We got prime rate, Fed rate, mortgage rates, that type of thing. So let's get an understanding of what those are before we dive into that. So JJ, you want to kind of tell us about what the prime rate means to our viewers?
Wow, this the retail bank. That man said with the prime rate.
All right. So from my understanding, the prime rate is that initial baseline rate. Of course, initially, if you did apply for a loan and you did meet all the qualifications, typically your base rate is going to be the prime rate. Initially, from recent cuts to the Fed, it did drop 0.25%. So the new prime rate is 7%. That 7% is going to be the baseline. And of course, when you include the other factors as far as creditworthiness, debt to income ratio, and just your relationship with the financial institution, that can fluctuate your rate a couple percentages more or, depending on where you are financially, of course. From a lending standpoint, if you are a consumer, the prime rate is initially going to be where that rate starts at. If you've gotten any type of personal loans, auto loans, lines of credit, initially that prime rate, once again, is going to be that baseline. And then depending on your credit worthiness, depends on how many extra percentages are added to that rate.
What type of loans are affected by the prime rate?
Prime rate, from my knowledge, I've seen the credit card interest rates get affected. I've seen personal loan, lines of credit, auto rates as well. As far as mortgages, typically are affected, but from what I've seen, of course,
we'll get that over to JJ.
Yeah, absolutely the expert in that field.
By that, yeah.
But typically, from what I've seen, it's pretty much mostly lending, consumer lending, and a few business products as well. Even with the business loans, SBA loans as well too. That prime rate is initially what I've seen affect those.
Yeah, it's usually affecting those short-term rates or those like credit card, variable type rate type programs, but also. The federal rate. So we hear last week, the Fed's meeting, they're talking about cutting rates. They're not actually cutting the prime rate. Ultimately, it's affected by the rate that the Fed's cut, which is the federal rate. The federal rate is basically a short-term lending rate that banks can borrow money from one another, right? Short-term things to cover their depository requirements from day to day. So that's the rate that the Fed meets on to kind of standardize that. And then from there, obviously that affects the prime rate. Yes. So when we're talking about the prime rate, let's say it's 7% and the Fed's cut the rate to, 3.5%. The spread there is what the bank makes to profit to be able to run and operate, right? Mm-hmm. That's why they're lending out money there. So when you hear that the Fed cut the rates, if you see that and you see the rate's 3.5%, that's not necessarily the rate that our consumers are going to get or see on their lending. Right? They're going to see the prime rate for it. But all in all, it's usually directly affected by that. Now, things like auto loans, things like that, those are determined in a different fashion, which I don't fully understand how they do that, but it's not necessarily based upon the prime rate like a credit card or a home equity line of credit, something like that, right?
Yeah. Well, when you say mortgages and prime rate, I guess, ways it's affected. If somebody has an adjustable rate mortgage, that's basically what it's based off of. And I know that is a positive when they cut their rate. Anybody that has a variable rate, whether it's a mortgage or any type of variable rates, you actually obviously you're paying lower interest. That's where you're gonna benefit.
So are the variable rates nowadays based directly off the prime rate?
Correct. Whatever the T bill is. It's a whole complex, formula that when I get somebody, I pull it out and I break it.
Many years ago, when I was in the mortgage industry, and variable rate loans were much, much different than prior to 2008. They were based on a different model, like a interest rate model, the LIBOR, which was the London National Bank rate at that time. So I've been out of that side of the field for a long time, but nowadays they're based on the prime rate, has a direct effect on that, right?
Yeah, but and then when he talked about the rate, we hear about the Fed cuts. There's no. It doesn't affect the mortgage rate per se, and that's the first thing people will do is pick up the phone and say, "Hey, I heard the Fed cut rates." Down. Yeah, correct. And but it's not. The only thing when you do your research is a psychological aspect of the industry, but there's no direct effect from the Fed cutting the rate on mortgages.
Mm-hmm. Gotcha. So obviously with a big rate cut there, big news, I should say, with the rate cuts last week, that helps the consumers, right? In our time period, bringing down the rates that they pay on their credit cards and overall lending, things like that. What does that mean to the other side of that? Not the borrowing, but the paying when it comes to CDs and savings accounts. What's that look like?
Typically, when you do see that Fed rate cut, of course, that, as you said, does affect the prime rate and typically does affect the rates of what consumers are getting in terms of a return on their investments. To talk about CDs specifically, of course, I've noticed some CDs have dropped. They haven't dropped as much as I've noticed. They are still, I would say, probably upper to that upper threes, closer to the fours. But essentially, with that rate cut, of course, that does mean that you will see a CD rate drop as well, too. And that is just because, as you also said, banks with the borrowing from the Fed, of course, they still have to have that prime rate so that they are still able to gain a profit, of course, for operating expenses, etc. With that being said, they're unable to give you the same amount of return on your CD because at the same time, banks are in it to make money. They have to have a profit. Of course, if they're paying out more than what they're getting in, at that point, the bank will be losing money. And of course, you don't want your financial institution to do that because at the same time, if they lose too much money, the doors are shut.
Yeah, ultimately, I mean, that's one of the main purposes for CDs out there from lending institutions is to drive deposit into their bank, right? To be able to have those assets on hand, to be able to lend, right? So with CDs out there, if they can borrow from the Fed or borrow from another bank at 4.25%, but they can borrow from you at a 3% because they're offering you a 3% CD, right? They're saving some money there by doing so. So they're really getting an interest rate out there to the consumer to drive their deposits to be able to get those funds that they need rather than borrowing them from somebody else. Right.
Yeah.
Same thing with the savings accounts. And taking a step back there with CDs to kind of understand when you say 3%, not all banks have a 3% CD.
Correct. It is very much dependent on the financial institution and what they're capable of giving at that time. Same thing with the money market rates, saving rates, of course. I've seen a slight dip in the money market rates as well, too, of course. Has to do with the Fed cuts as well, too. So pretty much it's just making sure that your rates are aligned with what works best for you financially for your institution, essentially.
Yeah, that's one of the biggest things, having worked for one of the largest banks in the country and now a smaller local hometown bank is, when I worked for the larger bank, the biggest thing people call at times like, man, why don't you guys pay any interest? And the response to that was because of how large we are and the amount of deposits we have on there, we don't necessarily need to buy your deposits, right? We don't need to pay you 3% on there to drive more deposits because we are so large and we have some. Now, that's not good for the consumer to hear because all they care about is getting their interest. But it does show strength and stability of the financial institution, right? Which should also mean something to the consumer too. But ultimately, they're worried about the interest. Smaller, local, hometown, regional banks, things like that, they got to pay those interest rates to be able to drive the deposits in, to be able to lend back out and make that profit.
I just wanted to throw this last thing in. Also, another thing with you talking about these smaller institutions, credit unions, I have noticed typically do have those higher CD rates as well too, certificate of deposit rates as well too. And I would say one of the biggest things that I'm starting to notice that financial institutions are doing more frequently than what I've seen is they're starting to offer that rate match just so that they aren't losing the capital that the clients are bringing in from the deposits. So again, if you are out CD rate shopping, and you don't initially want to leave your financial institution, always ask them about a rate match and see if they're capable of giving you that higher rate that another institution is offering you.
Yeah, you may or may not get it, but ultimately it's always worth an ask, right?
Yeah. But I mean, we got to remember the main reason for rate cuts is to stimulate the economy. So therefore, when you're borrowing, you got lower interest rates, which in turns, and you potentially could be, investing more. So yeah, the CD, we took it that avenue. That's one side of it, but really the main reason that they're doing it is to slow job growth and to stimulate the economy. So with that effect, hopefully people invest more and you borrow more.
How it affects the stock market, things like that.
Correct.
I know, I believe we're supposed to have our friends from DR Financial maybe on the next episode, next show, to kind of talk about investing a little bit. Maybe we can talk to them about how interest rates affect that and the direction that they go with their investments. Difference between high interest rate environments and low interest rate environments and investments there. Yeah, definitely.
That's definitely.
So, lending wise, anything else on the mortgage side? How are rates since the rate cut? I mean, did you see an increase, decrease? What did that look like?
No, you know what? Rates have been hovering right in the sixes. I saw a national average of 6.1 to 6.3, and we're at 6.375 at Lake City. So they've been pretty good. I know the Fed wants to cut rates again. Not that this is tied in, but I was just gonna say they're looking to have another cut maybe in December. But again, it's funny because there's divided opposition. That some people think, let's do the cut. Some people just want things to stay the same and let it work out, through a natural course. So if that happens, I'm sure mortgage rates will probably drop.
This last cut last week, they were saying that it's we ended up cutting it, but ultimately there was some discussions there. Some didn't feel that we should cut it at this point in time.
Yeah,
I think that also had a little bit to do with the government shutdown, which is a whole other topic. But but yeah, so when we hear in the news Fed's cuts rate or thinking about cutting rates, stuff like that, that is a common thing in our world. We're always hearing they may cut rates. Sometimes they do, sometimes they don't, right? But they have. This was the second time this year they cut the rates, right? I think they cut it earlier in the year.
Yes.
Second, and then they're expecting to possibly cut it, one more time this year.
Correct. They said, as low as 3% by 2026. So that's what I heard. And I know, Powell, the chair, basically said there's no formula. It's not like a preset destination, but it's just playing it by ear. So
yeah, I think on this one they said with the government shutdown, all the metrics that they usually look at to determine whether they're going to cut that rate, they didn't really have up-to-date metrics on jobs added and unemployment and all that type of stuff to kind of make that decision. So
yeah, and that's just it though. And when we're talking about our economy, you said that's a whole other discussion, but at the end of the day, we're talking about people's livelihoods. And people, missing out on, benefits, people whose jobs have been cut. And I just heard, air traffic controllers talking this morning, and they said, a couple of them, they said, we could afford to miss one paycheck, which they already did. He said that second one is going to get interesting. So, it is. We're in a tough place, and I understand, we're trying to do things to battle, inflation and offset some of this stuff, but it's real.
Hold on a second. You said you heard some air traffic controllers talking. Do we not have air traffic controllers right now with the government shutdown?
You said, do we not have one?
Is that what I took away? They're missing their paycheck because they're not working right now?
You didn't realize that. They're not getting paid.
No idea. Who's flying who's directing our airplanes right now?
The air traffic controllers for free.
For free.
Yes,
correct. That's
they're
the
all
issue.
working
Yes,
for free right now.
Oh, I didn't.
You didn't?
No. Hey, I don't watch the news on a nightly basis.
Lord have mercy.
No. I've heard about the benefits. I've heard about the benefits, that type of stuff. But I'm not being sarcastic whatsoever. So.
No, they that first paycheck.
TSA, all that, man. Yeah, and honestly, there's been some shutdowns in some airports. There's been a couple cases where people have walked out, but they're literally getting pay stubs, $0. And they got, like I said, they got one. Now they said they're about due for another one. It's going to say the pay stub, $0.
Wow.
So, yes, when I say it's getting real, it's getting real.
Yeah, absolutely, yeah.
Interesting.
Yeah. Like I said, I've focused on the benefits and all that stuff. Those conversations have been had, but didn't know about that part there.
Yeah, that's a topic.
Whole nother topic, like I said. So,
Yeah.
focusing a little bit more on the mortgages, you mentioned something about variable rate mortgages. What do those rates look like in this kind of environment market? I mean, are you doing a lot of those? I mean,
It's funny, and I think we talked about it before. It used to be the reason you do a variable arm per se is because the rate would be less than what your standard rate is. Now our standard rate and our variable rates are really in line with each other. So there's certain products, like when you're doing a construction loan, though, we only lend on an arm pretty much. So, and again, we're talking arm adjustable rate. When we talk about that prime rate or T-bill, you're looking after that 5-year period or that 10-year period of what it's going to be, which 9 times out of 10 it's going to be up. It hasn't been a period where that has gone down, but at that point in turn, going back to what we talk about our HELOCs and our refinances, a lot of times if you get there and it jumps substantially, people use that opportunity to refinance into a more conventional product, a conventional loan or something where you have a fixed mortgage or fixed rate. So,
gotcha. And then looking at different options for our listeners out there when it comes to, if you've, over this time period racked up some of those high interest rate credit card debts, things like that, some options to kind of consolidate that type stuff. You want to speak to that a little bit with consolidation loans, HELOC loans, things like that, how that can benefit our listeners?
Of course, if you do have access to a home equity line of credit, that is typically always going to be my first recommendation. If you are looking to consolidate a large amount of debt, of course, pay it all off one lump sum and then pretty much just pay down the high, I would say, value loan at a typically what I've seen single digit interest rate, of course. The whole point of debt consolidation is to essentially pay down debt at either a 0% interest rate or the lowest interest rate possible, of course. With credit cards, of course, typically you do see that 20 all the way up to like 30% interest. No one wants to be paying on that. That is astronomical.
And you're
in
paying
terms
the
of
minimum
interest.
payment, so you're never getting anywhere on it.
You're not going to get anywhere. At that point, your minimum payment is like laughing in your face at that point. Yes, it's still going to keep you current. It's going to keep all your payments up to date, but you're not going to put a dent in the actual principal amount that you owe just because of the interest alone. Of course, if a home equity line of credit is not an option for you, of course, there are potentially what I like to call balance transfer credit cards out there. Of course, typically what you can do, you can transfer the balance from one credit card to a 0% interest credit card. Typically what I've seen, roughly pay period is about 18 months, 0% interest. That is a great way to attack debt without having to worry about interest. Of course, make payments as you can. Of course, you can either set up a payment plan so you by the 18 months you have everything paid off, or if you're able to pay more on it, get it paid off sooner. Of course, if you do have extra debt, you can always transfer that over as well too within that 18-month period. Of course, small fact about that, there is a small fee that does come with that, transferring the balance to a balance transfer card. And then of course, I said last but not least, I would say like a personal loan, of course. As you've seen, personal loan rates are not the greatest, of course. Even with that prime rate being around 7%, of course, there are some other factors that do play into that as well, too. Of course, interest rate is typically always going to be lower than what a credit card is. I would say, just from my experience, those three would typically be the three that I would recommend.
Yeah. So what, for our listeners out there, let's help them understand, like, credit card, personal loans, you say the rates aren't that great on there. Why are those rates higher on those type of products than, let's say, a home equity line of credit or a vehicle loan, something like that?
So, it's this great word that I like to call collateral.
Collateral.
Yes. Home equity line of credit, you are essentially, again, you're taking out a lien against your home to get access to the equity that you have built into your home. Of course, if you max out that home equity line of credit and you decide, I just don't feel like paying this back, they can take your house. It is something that they will do. Of course, it does cost a financial institution money to take the home from you, but at the end of the day, what they're lending you is backed by collateral. There is if you default, we're going to get something of value back to make up for the difference in what you owe. Same thing for a vehicle as well too. Now, in terms of a credit card, that is what we like to call unsecured lending. You can go apply for a credit card, say they give you a $15,000 limit. You can max that credit card out and then refuse to make any type of payment on that. There is no guarantee that the financial institution is going to get any of that money back.
So for that risk that they're taking,
we're going to give you a higher interest rate
Yeah.
just because there's too much at stake, of course. So if you decide you want to miss a payment or you just don't want to make a payment, we're going to charge you even more because, again, at the end of the day, we are lending to you with nothing as collateral.
We got to make that money from the people that are paying to make up for the people that aren't paying.
Absolutely.
Right.
Financial institutions, especially banks, they are for profit. They want to make money. If there's an opportunity for them to lose money, they're going to try to find a way to offset that so it doesn't happen, so it doesn't affect them that much. Again, if you want to put your house up, yeah, we'll take your house. If you decide you don't want to pay us, we'll take your car if you don't want to pay us. But if I lend you $5,000, I have to give you a higher interest rate. I have to make some type of money back because I can't just lend to you with the expectation that you'll pay me back, but I have no way to guarantee that you will pay me.
Simply put, I've got skin in the game over here, no skin in the game. That's
Exactly.
what you're paying for. You got skin in the game, no skin in the game.
Yeah.
Back to the zero balance, I was going something that just hit me because I'm sure all you guys get stuff sent in the mail too because they send them to you all the time. Have you ever seen where somebody has done that multiple times?
Balance transfer?
Yeah.
I've seen people that lived off that.
Okay, that's what
18 months, they're getting a new credit card, transfer that balance over.
I strongly
so
recommend it for a couple of people. For instance, I had a client that their credit card was at a 33% interest rate.
Yeah.
I was like, I'm making my minimum payments. I'm like, you're going to be paying on this probably for the next 10 years. I was like,
So that'd be a strategy.
Yeah, I'm making it. Yeah.
It's a strategy, but also, one of the key factors in that balance transfer, paying it off, paying it down, is discipline.
Not
Doing
cycling
it
and doing it again. Yeah, of course.
Okay, I transferred to this card. Now the balance is open up on this card again. Let me start charging stuff again, right? That's just kind of counterproductive.
Or you pay off the balance transfer card. Hey, well, now I have 2 credit cards.
Yeah, absolutely. Now you got 2 credit cards. You're doing that. Now you got 2 credit cards you got to try and find balance transfers for. But to answer your question, yeah, I would have clients that do on a regular basis do it. I don't know that I ever had anybody that would do it that way. They would do a balance transfer and just go run up the balance over here again. It really was. But I mean, a lot of the balances, it takes more than 18 months to pay off. So it is a pretty wise financial decision to if I can find another one and transfer it so I really pay minimal to no interest over the next 4 or 5 years to get this balance I ran up, down. Yeah. But like I said, the key factor is that you learn some sort of discipline during that time period and don't do it again, which kind of takes us into maybe a conversation on budgeting, right? So our next workshop is coming up here next week.
11:15, yeah, Saturday, 11:15, Fort Wayne Urban League, 2135 South Hannah. Same format that we've had, good food, good camaraderie, good knowledge. As Ryan said, the topic will be barriers to budgeting and shortfall savings. As me and Terrence discussed, we'll probably do a lot of recapping, even, some things we did with the reality store and things we've done throughout some of the other workshops. The other unique thing or the good thing about the workshop this week, this session is it's time to give away the TV. It's time to give away the TV. It's there. It's that time. Yeah. So we'll reward the folks that have been coming. I mean, their odds are better than somebody that would probably be a first timer. But at the end of the day, if you're a first timer, you still have an opportunity to win that TV. And I know last year that's exactly what happened. We had a young lady who came. I think that was her first, and we literally had people who had stacks of tickets. But even with that said, we always, there's always good giveaways. Like we said, answering questions right. We pay you. That doesn't even have to work. But, there's our different vendors. We have different banks. Lake City Bank is in the house. I know Union Savings has been there. And different vendors around, and they all have different giveaways and things that are going on within the workshops. And so all that stuff will be there for, like I said, another good time.
Yeah, I can speak for the lemon pepper wings. They were great. Tried them for the first time last time. Yep.
First time?
Yeah.
Wow.
Yeah, those aren't usually my style of wings there, so I've stayed away from them before, but I think Tamara mentioned the lemon pepper.
There you
I was
go.
like, what is that on the wings? She's like, it's lemon pepper. So I tried one. Oh, yeah, they were pretty good.
Oh, yeah. It's even better on fries, too.
Now, quick story.
Even better when it's free.
Hey, lemon pepper Lou. Lemon pepper Lou. If you follow the NBA, he left the bubble to go get some lemon pepper wings in Atlanta.
What?
Yeah.
I don't know what that. What?
That's a whole. When during COVID, when they had the championship in the bubble, Lou Williams
Oh, so I wanted to we were talking.
left the bubble to go to Atlanta to get him some lemon pepper wings.
Did he get caught?
Yeah, he got caught. Everybody, they took his picture and everything. They was proud that he came to their establishment to eat the wings.
Need those wings. Yeah, yeah. You mentioned part of it, like, what was the term you used? Low budget savings?
Shortage of savings.
Shortage in
Yes,
savings. Okay,
yes,
so just
yes.
talking about. I know when we think of savings account, a lot of times people think of savings account to earn interest, right? But in all reality, most savings account don't pay a lot of interest nowadays. What you got to do is CD or like a money market or something else to get some interest. But obviously, savings account's a good idea as kind of a budgeting tool, right?
Yeah, correct. Savings account, or I mean, just when we talk savings, just how can I change my normal course of action and things that I do with my daily life. I can save a little money over here without buying name brand this or name brand that. And the other thing we talked about, the state of our economy. I mean, going to the grocery store, when I talk about getting it real, I mean, people, the price of eggs, milk. I don't know the last time you've been, but it is, things are expensive for people. And then not to mention even purchases, with the tariffs and things, it's adds to the cost of everything that we're doing. So I heard a lot of discussion talking about Christmas this year, and we're getting back to just doing family things and being together and not so much being
wise with your
commercial.
money that you have.
Correct. So I think all that ties into, when you're talking about savings. I know my family, we got a big group, and they typically, my wife gets with my sister-in-law and my mom, and everybody's cooking, and they got, food that's just ridiculous. We end up giving it away like we're at the, at the rescue mission or something, because that's how much food they have. This year, that's what they're talking about. Hey, everybody's going to get a dish. You bring a dish, and that's going to be it. So, we're cutting back when you talk about savings. So,
Gotcha.
Yeah.
So, we got a couple minutes before we get out of here. Anybody have anything to add?
Like we said, next episode this month we'll have DR. They'll be in. It's going to be good.
Confirmed?
Yes, that's
Good.
yeah.
It's been a while since we had Chris and
Mark
on the
yes.
show. Are they both coming or one? Or do you know?
I think both said they
Both?
could be
Oh,
available. So, because that was my thing. I said, can one do, the first part, the other, but they both, were kind of busy, but said they'll be on the next one. So, yeah, I got a lot of questions for them. And, they always share some light on some things. And, Mark has some great stories to share that, it based in reality. So,
yeah, Pastor Mark, bring us in with the prayer next time, too.
Oh, no question. No question.
So, all right, guys, great show. Look forward to being back with you guys in 2 weeks. But until then, we are our neutral voices. Peace.